Well, now we're going from battling with the banks to being in battle with the bank, being part of the same side, looking at partnerships, a bank with FinTech. And to do that, we've got a couple of fantastic speakers. Mark Collis from the Newcastle Permanent Building Society. We have Michael Starkey from Athena Home Loans, a FinTech that has built an extraordinary business here in this country. And to moderate this panel from ACS Labs, we have Siobhan Casey. So, ladies and gentlemen, please give our next panel a big hand. Thank you.
Thanks, Simon. One quick edit. We have, Mark is not here. We have Brian, Group Treasurer from Newcastle Permanent Building Society. And we also have a very interesting stat. We have Newcastle Permanent Building Society opened in 1903, having a partnership with a business that opened in 2017, so 114 years between the two gentlemen here on the stage in business entities, of course. So over to both of you. First off, what your role is, and then perhaps what you could talk about initially is how you came to be in a partnership. What was the pain point you were both trying to solve?
Yeah, so Michael Starkey, co-founder, Chief Operating Officer, also CFO for Athena Home Loans. We started the business, as you said, in 2017 with a view to really being a non-bank lender, so cutting the spread between where wholesale money is originated and where retail borrowers get their money. We had always envisaged a sort of a whole loan sale or portfolio sale arrangement to how we funded our mortgages. And we can talk a little bit more about later about how we see that working in the broader economy. But we began our journey with traditional warehousing and securitisation markets. And we were introduced to Newcastle Permanent by KPMG, actually. They were working with Brian and the team there, and they introduced us in March 2020 through a person I used to work with back in my consulting days. And
was it before the 17th when everything shut down, or after the 17th?
It was after. This whole thing was done in COVID. We were supposed to meet face to face, and then at the last minute it turned into a Zoom. And so I only met the guys about a year and a half after we'd done the whole deal.
Wow.
Yeah.
Brian Reid, Group Treasurer of Newcastle Permanent. As the guys have mentioned, we've been around for a long, long time, and we're really a member-based organisation, which differs from banks in that we're there for our members, and members own the equity in our organisation. So we're a small-sized bank, and I guess one of the key changes we've seen in our organisation over the last couple of years is really a tilt towards innovation and growth. So, we've been a staid, very conservative organisation for the last 115 years. I guess with the need to continue to have relevance in the retail banking market, we've had a much clearer focus on developing partnerships with guys like Athena, but also more broadly in terms of looking at opportunities to better meet the needs of our customers now and into the future.
Cool. So let's walk through the relationship, the partnership, and what was that ideation process like? What were the big challenges maybe that you identified?
So for us, it's really, as a non-bank, we can't create money out of thin air like ADIs can, so we have to source wholesale funds. We had done so through warehouse arrangements with big wholesale banks, both domestically and globally. We've got a securitisation program and all the rest. But our vision was to actually simplify that process and source funds directly through a non-structured way in arrangements like this. When we set up the business, we initially thought that was going to come from superannuation companies. So we wore out a lot of shoe leather meeting every super fund in the country. So we always had that vision of sort of whole loan portfolio sales as a way to fund a mortgage, as a more efficient way to fund the mortgage book. So for us, it's really A, around growing the book, so we needed to source funds. B, around diversification, because as we saw in COVID and at the GFC and actually right now, wholesale funding markets can be very disrupted. So if you have a diverse set of funding arrangements, you're going to be much more resilient through the cycle. So really, and then the third one for us is really it's a capital efficient play. We want to be a processing business. If you look at most lending companies, mortgages is on the capital efficient side of things, but they can be very capital intensive. So to grow a book we've settled 5.5 billion loans now. If you're not very careful with how capital efficient you are, you end up asking your equity holders to put in millions and millions of dollars equity capital. So those three things for us: capital efficiency, diversity, and just growth.
Yeah, it's interesting. Many of the points Michael raised are also key points for us as well. And that I think if you look at the transaction, it's really a complementary transaction for both parties in the sense that Michael has a need for capital optimisation, as do we. So we need to put capital to work for our members to generate profitability, to bolster up the capital for when times get tough. And also, I'm not sure if you remember, in the middle of COVID, loan growth had really suffered. So as a consequence, we had a balance sheet that had over $1 billion worth of equity and probably about $600 or $700 million worth of surplus deposits. So, as Michael mentioned, there was a need for a partnership model that really works well for both parties, and that, bizarrely, we satisfy each of our needs in both ways. So.
And any regulatory challenges? Did you have to engage with APRA, or was it fairly straightforward?
Yeah, look, we're a pretty heavily regulated entity, so I guess one of the key things here is to make the deal really successful is generating a capital treatment from APRA that reflects normal mortgages on our balance sheet. And we had to go through quite an extensive due diligence process to satisfy APRA, and that put a lot of, I guess, not so much stress, but a lot of work on Michael's side and Michael's team to generate some of these documents. And I think your Treasurer mentioned it was akin to an equity raising at one point, just in terms of the level of DD we went to. And it also means that there's significant ongoing governance activities around these particular transactions. But if you look at it in terms of good business management, a lot of what APRA has in place actually is the right thing to do, irrespective of its regulatory obligation or not.
Anything to add?
No, so as a non-bank, we're not APRA regulated, so it really was satisfying the needs of APRA, but I think it was really encouraging that APRA was supportive of this sort of arrangement, because I do think it speaks to the broader opportunities, because the big picture here is really around capital flows and where borrowers ultimately get money from and how that is funded, right? And so the fact that they were willing to engage and support this sort of deal, I think is a really good sign.
Can I ask a question? I mean, you got together, the relationship kicked off at the infancy of COVID. If not for COVID, do you think this would have happened? Or is this a COVID baby?
On our side, we certainly would have still had the need, because we were growing quickly. I think what COVID did was underscore how important it was for organisations like us to not purely be reliant on one source of funding. So, as I said, we've settled now $5.5 billion. At the time that COVID hit, I think it was about $1.5 billion. And we were sort of reliant on one or two big institutional funders which had the jitters during COVID. So COVID really, for us, underscored how volatile and fragile the capital markets can be. And for a business like us that needs a consistent flow of funds to grow our book, it really underscored the importance. So our need would have been there, whether or not your surplus liquidity would have been as much of an issue. Yeah.
Look, I think when you look at what banks do, banks effectively look to generate mortgage growth, and they do that through various distribution channels. So we've got essentially two prime channels, which is our broker network and our principal channel. So what Michael's deal pulls together is an alternative distribution channel which allows us to diversify outside the Hunter region. So Michael's book is national, which gives us a fantastic opportunity to diversify the absolute level of credit risk across our portfolios, and that actually generates quite significant benefits from both a risk perspective, but also in terms of how we think about different touch points nationally.
It's sort of a good lead on then. So when you started this relationship, you probably had key measures of success that you were looking to achieve. Were they achieved? It sounds like they were, but did you find any other mutual benefits along the way? And what do they look like?
So for us, I guess jointly, the economics had to be sensible for both parties, and I think it's been beneficial there. We didn't want to introduce any undue risk again to both parties, and I think, if anything, as Brian said, we've probably diversified and sort of reduced risk in both parties, I think, there. And then operational complexity. What we didn't want, we wanted this to be a very efficient transaction. If you think about and there would be various levels of understanding in the audience around how structured deals work when you're trying to finance a business through RMBS. It is quite complicated because there's lots of different parties involved and lots of different legal arrangements involved in an RMBS structure. What we aim to do here is to keep that quite simple, and so that operationally, I mean, when we did our last transaction earlier this year, it was very, very, it was very straightforward. And so those three objectives for us were met?
Yeah, look, I think as any sense of true partnership, I think we all learn from each other across time. So, there's aspects of Michael's business that, our executives have picked up and learnt from. I'm sure there's some aspects of our business that Michael's potentially learned from as well. So it's more of rather than a transactional relationship, it's more of a deeper partnership model. And it's about actually sharing the knowledge and information that we pick up more broadly to make the partnership better.
What other interesting partnerships have you seen between the sort of traditional banking and the fintech space?
Yeah, look, I think there's a couple of really interesting ones out there at the moment, and the different variations on the originate to distribute model. So you've got fintech such as Nano, who in some respects are a little bit similar to what Athena does, but they're also looking at, I guess, the software solutions that come off the back of it. And then there's other pure loan players that are probably smaller variations of Michael's business. So I think there's a fair bit of diversity in terms of what fintechs are actually doing out there. I guess the challenge is, and Michael touched on it, is how you diversify your model to ride out the longer term ups and downs of the economy and financial markets volatility more generally.
Yeah, I mean, for me, it's one of the big changes in the financial services scene over the last decade, because I was at NAB for 10 years before starting Athena, and I think you've seen a lot more of these sorts of arrangements that you referenced. So you had the likes of Nano and TikTok, and I saw Dom floating around there from Upbank. I think that's a super example of a brand new sort of Ferocia, a brand new company working with a traditional lender in Bendigo. So I think you're seeing a lot on in the payment side. You're seeing a lot on the transaction banking side. Lending has been more. I think what we've done is actually a little bit quite different and unique in some ways. Lending has tended to be more arm's length wholesale funding arrangements to date. So I think you will start to see more and more people looking at their legacy platforms and saying, okay, I could either rebuild this from scratch in a very large and risky project, or I could sort of piggyback on the work that a new player like Athena has done. We've probably invested 100 million in our platform, and we're about to announce some really exciting partnerships with players, very powerful players, but who just want to accelerate their path to market. Yeah.
Awesome. Let's stay with that, Michael. The mortgage funding point of view in Australia v overseas. What are the key differences, and what do you think we could learn from the overseas markets?
Yeah, so the big difference, like if you think about Australia, it is very much dominated by banks. So ADIs account for, I think, around about 95% of all mortgages written in this country, and it's probably something that those of us who've lived in Australia our whole lives sort of take for granted, but it's just not the way other markets around the world are shaped. So in America, non-banks account for about 50% of the market. They took a bit of a hit during the GFC, but they've recovered to about 50% of the market. So you have capital markets that support non-banks participating really strongly in the prime space there. So players like Rocket Mortgage are now, I think it might even be the biggest lender now, home lender in America. It's a non-bank. So they sort of fund themselves in a similar way to what we do. So that sort of market, in the Netherlands, you have superannuation funds and insurance companies buying directly portfolios of mortgages from mortgage originators like us. That's the vision that we had. We haven't quite cracked that. We haven't given up on that vision, but we do see that super funds hold hundreds of billions of dollars of bank deposits. They have billions of dollars of bank equity. They have billions of dollars of bank mezzanine finance. What they're really funding there through a very inefficient way is a mortgage. And so why not just buy the mortgages directly? So that's, we are of the view that, there's scope for Australia to look a little bit more like America or Canada or Europe, where non-banks are, instead of 5% of the market, are 30, 40% of the market, and that's the wave we're trying to ride.
Is this a regulatory issue that needs to change in Australia for that to occur? What's got to be the stimulus?
It's a really good question, I think, and it's one we ask ourselves all the time. How do we unlock this? It's clearly not the way it works in overseas markets, but it seems difficult here. I think it is a combination of some regulatory issues. So there's a couple of examples there. One is the way capital treatment works for wholesale lenders. There seems to be a little bit of a punitive treatment there, which means that large wholesale banks can't own, they can only own AAA to get favourable treatment. Brian would know a lot more about this topic than me as a treasurer. So there's a combination of things. That's one. The other is to just look at superannuation and how we judge our super funds. We tend to judge our super funds purely based on return, not a risk-return balance. So Aussie super funds are very heavily skewed towards equities, and they looked at, when we tried to pitch our idea, we got quite a lot of interest, but ultimately it was a very boring asset class for them, and so we didn't get a lot of take up there. So it's a really good question. What is it going to take for Australia to head down that path? But one thing's for sure, it needs players like us to be originating high quality mortgages, and then hopefully we'll get the support on the other side.
Great. Brian, how can the mutual sector leverage new technologies to remain relevant?
Well, I think it's not how can they, it's how will they. Because if you look at the banking sector at the moment, retail products are essentially a commodity-based product. So margins are very tight. So OPEX management in terms of more efficiency, reduced FTE costs, etc., is the new black. So when we look at potentially efficiencies across the organisational stack, fintechs will play a major part in that going forward. So that's anything from making the AML KYC process more efficient, all the way through to the whole concept of how we think about open banking and trying to monetize some of the values coming off the back of that. So it's going to be a much more competitive environment going forward, and we're starting to see that through the mutual sector already with a number of smaller type partnerships popping up.
Yeah, there's been a lot of consolidation in your sector. That obviously gives you more, I suppose, buying power or more influence over perhaps sharing new technologies for the space. X15 Ventures yesterday was talking about opportunities in the future around saving money from their OPEX spend year on year. It's generally much higher in the mutual space. What are you seeing in that area?
Yeah, so there's a couple of things going on. So you mentioned the consolidation in the mutual space. So at the moment, there's two large mergers going on. So you've got the People's Choice Heritage merger, which will produce or generate, if successful, the largest mutual group in Australia, circa 22 billion in assets. We've currently got a merger in play at the moment with Greater Bank, and we'll land at about $21 billion of assets. So as you can see, the sector's starting to bifurcate just in terms of size. So I think that the real challenge there is, going forward, how do mutuals utilise that size and, to your point, buying power to make the entire process more efficient. So as I said earlier, it's a commodity-based business, but unfortunately the threshold for success isn't 20 billion, it's much larger. So to get those optimal levels of scale we see across the larger banks, I guess the line in the sand is probably $50 to $60 billion at a minimum. So I think the consolidation piece is going to play out a lot more as we evolve over the next 5 to 10 years.
Okay. I'm aware, again, I've seen them on the floor and people have referenced that we've got all the regulators here at Intersekt, which is great. Maybe they're in the room today, I'm not sure. What role do you both feel that they have to play in relation to facilitating innovation within our sector?
So I think that really important role, and there's a lot of important consumer protections because there's a lot of cowboys out there, and I think all of that regulation is something that fintechs should be able to deal with more efficiently than in some ways the larger legacy players. So really important role in protecting consumers in that space. I do think there's a balance on the prudential side and the competition side as well there. So I don't think it's in anyone's interests to have all of the banking so concentrated in this country among just the big four. And you see now Suncorp now part of ANZ. So there's really only the mutual sector plus two remaining I would say regionals in BOQ and Bendigo, and then fintech. So I think the role the regulator can play, and I'm talking about the RBA and APRA and obviously the ACCC, is to sort of recognise the importance of healthy competition, think about the way in which they approach prudential regulation and also interventions like the COVID intervention. Think about how they're going to impact the various constituents there to facilitate competition, because as I say, it's in no one's interest for everything to be concentrated in the big four. So there's lots of sort of parts to that. I think there's what are the capital rules? How can you encourage the non-bank sector? How can you support the mutual sector in providing that competition that's sorely needed? From an ACCC point of view, how can you look at some of the lending practices there, particularly around the mortgage discharge process? There's a lot that can be done, and we'd sort of almost welcome a continued dialogue with all the regulators to inject ideas into that scene, right? We do need competition.
We've got afternoon tea in about 10 minutes,
Okay,
so you can
so-
chat over coffee and cake. I might actually open up to the audience a bit more time for anyone to ask any questions of this relationship or anything to do with fintech and more traditional mutual space.
There must be some questions. I'm going to ask one just off the back of, I realised I'm one of the 5% because I am my mortgage lender is not an ADI institution. But I did have this thought, mortgage insurance, how big a piece of bullshit is it and how soon can we get rid of it? Because does anyone ever have a mortgagee sale where the bank loses its money?
It's really good. So let me set this here. You can have a shot at this as well, Brian. I won't let you off the hook. But we've only to date lent a less than 80% LVR. So we actually don't have LMI in any of our arrangements, just by virtue of which part of the market we're playing in. I think you do have to be a little bit careful in that Australia's hasn't really had a recession in 30 years. And so we don't, other than management judgment or about what's going to happen in the future, you don't really have any history to rely on. And you don't, and what would really happen in a genuine downturn would be the question on my mind. What I struggle with mortgage insurance is a little bit like what happened in the GFC. If you do get prices falling by 40% across the board, then those insurers are nowhere near well capitalised enough to support what would then be the result. So it really it's more an isolated issue that organisations should probably end up self-insuring for. So that would be my take.
Yeah, pretty similar. I think the fact that when you look at the quantum of mortgages in the market that do have LMI, you look at the balance sheet of the LMI providers, and even a relatively medium-sized downturn, they're going to struggle to pay out claims in full. So you probably more broadly question the logic of having LMI more generally. I get the point that, in essence, there needs to be some protection for the originator for more riskier mortgages. The question is whether it's an upfront fee or through price. So we can always go down the path of risk-based pricing for the additional potential risk of much higher LVR mortgages, but again, that creates a different form of tension in the market.
Thank you, gentlemen. Now, question.
Hi, you sort of mentioned, I guess, the concentration in the big banks. The big banks themselves are profitable enough to consume a lot of fintechs, and often that's even the exit strategy for a lot of fintechs. I'm wondering what your commentary around, how do we do anything about that? Is it a good thing, or it potentially forces itself to narrow and consolidate anyway?
I think it's a really good question. My view is that you can't discourage it too much, you can't shut down that avenue of exit too much, because there's many, because you might inadvertently discourage entrepreneurs from going out and starting a business if you say either you succeed completely independently and we're not going to let a bank buy you, because that is a pathway that's always in the back of a mind. Even like Athena. Athena's been a great business. It's a fantastic business, and our plan A is not to sell to a bank. Our plan A is to be a great independent lender. But if you were to say that's not a pathway available to you at all, then it just introduces a new level of risk for entrepreneurs there. So I think that balance between encouraging people to start businesses, knowing that if they hit a single and not a home run, they can still maybe fold it into a bank and keep going. I think it's important. It's an important thing. A lot of, we're just having a conversation around partnerships between fintechs and banks. A lot of great fintechs are providing services to the banks, and so they're an important part of the economy as well. But the broader point about there is a concern I have around that concentration. So I think, but the answer is to provide an environment in which firms can flourish independently, because I don't think it's many people's plan A to end up selling themselves to a bank. But it's kind of the reality when the environment, like look at the was it 86-400? They had great sort of ambition to become a bank, and I think when COVID hit, it was just too difficult. So, and they had a brilliant exit and all the rest. So the answer is more create an environment that businesses can thrive in so they don't have to, you know.
Hi guys. Sean from Nano Home Loans. So thanks for the shout out. My question might be a little bit cheeky, but really keen to get, well, both your views actually on if you were starting again right now as a kind of a new company, what advice would you give to budding entrepreneurs that are entering the home loan and prop tech space? And do you see any niches? Right at the grassroots level that are underserved and need extra support?
I think he's after your strategy.
And I think what both of our organisations have demonstrated is that there is, in a $2 trillion market that has a very complicated value chain, there's all sorts of different ways of playing in that value chain. We've gone down the path of being very much a non-bank end-to-end mortgage player with our own funding program and marketing and distribution and brand and all the rest. But there are very successful models that are completely different, like a Lendy, who is a digital broker, if you like, and then yourselves are doing service provision into places like AMP, right? So I don't know a lot about Nano, but I think it is just such a large market, so dominated by companies that have legacy technologies, like something like 95% of the mortgages in this country must be written on very old tech in origination stacks into very old tech servicing stacks. And so there's just tremendous opportunity to have better origination capability and better servicing capability. And whether you do that by playing in one slice of the value chain or try to do something end to end, or in our case, we were trying to do something also with the capital flows, as we've just been talking about here. I think there's just lots of different ways of attacking that market, and I think there's huge opportunity for great businesses like yours and ours to succeed there.
Brian?
I think it's a really good question. I mean, I think the first thing you've really got to ask yourself is, do I want to compete with banks head on, or major banks head on, or do I want to pick pieces of the market out where major banks may be disadvantaged via regulation, complexity, or just general size of the market or operational efficiency? So I think in that context, both yourselves and Michael have picked out, I guess, areas where banks have specific pain points. And I think that the key to that is putting the customer's needs first, but also doing it in a really efficient manner. So as I touched on earlier, this is a commodity-based market. The way you extract value from the market is not only meeting your customers' needs, but also doing it in the cheapest way possible without cutting corners.
Thanks. I think one more.
Hi there. I'm happy to say that I'm an Athena customer. So not to call myself a cherry, but it feels like in terms of Athena, the sort of cherry picking strategy of like going after customers that are relatively low risk in terms of trying to like pull them from the banks and like from a better service standpoint, being able to offer like a better price. Has partnership with like Newcastle Permanent allowed you to sort of expand your risk appetite in terms of the types of customer that you can serve? Because it's still a huge problem in Australia in terms of people's access to mortgages. So that's still my only concern. Like a lot of the fintech and home loan market is still sort of attacking the sort of cherry picking problem, as opposed to trying to solve it from like the customers who are still massively underserved.
So it has the potential to, and we haven't yet. So what we've done, and we've actually already had these types of conversations around what more can we do with that partnership. Our strategy is actually, it's a classic Clayton Christensen disruption strategy, right? Which is you come in with something very basic and then you build up over time. So when we started when we launched in 2019, it was redraw only, very strictly, almost PAYG. We only had a refi product, so you couldn't purchase, right? Then later that year it was purchase and refi. Now we've got an offset account and better payment capability. So we sort of gradually got better and better in terms of product features. What we're doing now is we are looking at different segments now that we've got that base in place. So we We will be able to expand out and do 80 to 85, for example, very soon. We will be able to do more business purpose. We'll have more of an offer for investors and other sort of more specialist segments. So that the partnership with Newcastle hasn't yet done that, but that's exactly the sort of thing that you guys would have appetite for and we could work together on. Yeah.
Yeah, I think the really relevant point there is the capital framework changes as of 1 January, and those changes are going to drive those sorts of pricing dynamics across the market. And I mean, I think the broader question is, if I missed it, I apologise. It's more of financial inclusion, so how we offer products more generally across the market that meet not only the great mortgage customers with great credit quality, but the great customers with lower credit quality. And I think that's always a challenge under the risk weight capital framework, in that there's a really tough upfront cost in terms of LMI, plus the risk-based capital charge that'll go with that. So I think, to Michael's point from before, the areas around financial inclusion are areas we need to work with both the regulator and the government to think more broadly about that balance between system stability but also what is social good.
Excellent. I think we've finished on that afternoon tea. If everyone could join me in thanking Michael and Brian. Thank you.